Volkswagen is one of the most esteemed car brands globally, symbolizing Germany's industrial prowess and innovation. The brand's origins trace back to 1937 when it was founded after Adolf Hitler envisioned a people's car. This idea materialized into Volkswagen, whose name itself translates to people's car. Over the decades, Volkswagen became synonymous with Germany's reputation for engineering excellence and mass production of reliable vehicles. Yet now, this iconic German brand faces an uncertain future as Chinese investors appear poised to take advantage of its vulnerabilities, acquiring struggling factories to reshape not only Volkswagen's destiny but also the global automotive industry. Volkswagen has long been a cornerstone of German identity, a symbol of the nation's post-war recovery and industrial might. Its contribution to the Wirtschaftswunder, or economic miracle, following World War II is immeasurable. Through precision, quality, and innovation, Volkswagen rose to global prominence, manufacturing iconic models like the Beetle and Golf that became household names worldwide. These vehicles were more than just cars. They embodied German ingenuity and leadership in industrial innovation, helping to craft a modern, industrious image of the country. Beyond its cultural impact, Volkswagen has been an economic powerhouse for decades. It provided employment to thousands in Germany and across the globe. Its vast network of production facilities and dealerships made it one of Germany's largest employers, supporting families and communities. By acquiring prestigious brands like Audi, Porsche, and Lamborghini, Volkswagen positioned itself as a dominant player in the global automotive industry. However, the company now faces unprecedented challenges that threaten to erode its long-standing influence. The global economic slowdown has taken a toll on the automotive sector, and Volkswagen is no exception. In 2024, the company's global deliveries declined by 1.4%, with total sales dropping to 4.5 million vehicles. Its third-quarter revenue fell sharply, decreasing by 41.7% from $5.3 billion to $3 billion. Moreover, profits plummeted by 60%, a concerning trend for a brand of Volkswagen's stature. Despite these struggles, the German government has been hesitant to provide significant financial aid, with officials emphasizing that the company must solve its problems independently. Declining demand in key markets such as Europe and China has exacerbated Volkswagen's woes. China, once a stronghold for the brand, has increasingly shifted its focus to domestic electric vehicle (EV) manufacturers, leaving legacy automakers scrambling to maintain their foothold. Simultaneously, Volkswagen's factories in Germany, such as those in Dresden and Osnabrück, are underutilized. High labor and material costs in Germany have made these facilities less competitive compared to manufacturing hubs in lower-cost regions. Efforts to restructure these plants have faced resistance from unions, creating further obstacles. As Volkswagen grapples with these challenges, China has emerged as a potential savior. Ironically, after years of curbing Volkswagen's influence by promoting local brands and EVs, China now sees an opportunity to acquire struggling German car factories. But why is China interested in these facilities? The answer lies in its strategic goals. China faces significant barriers to accessing Europe's lucrative EV market, largely due to steep tariffs imposed by the European Union. Recently, the EU introduced duties exceeding 45% on Chinese EV imports, citing unfair government subsidies. These tariffs make Chinese vehicles significantly more expensive in Europe, reducing their competitiveness. However, by acquiring factories in Germany, Chinese automakers can bypass these trade barriers entirely. Producing vehicles locally eliminates tariffs, enabling them to offer competitively priced products in the European market. Beyond cost savings, local production enhances the appeal of Chinese brands among European consumers, who often prioritize vehicles made within the region. Establishing a manufacturing presence in Germany, a nation synonymous with automotive excellence, also bolsters the credibility of Chinese automakers. For China, this move is not merely about reducing costs. It is about reshaping global perceptions of Chinese manufacturing and positioning Chinese brands as equal competitors to traditional European and American automakers. Germany's central location in Europe provides additional logistical advantages. Producing vehicles within Germany allows for faster delivery to key markets, better responsiveness to consumer demand, and more efficient supply chain management. These factors make Germany an ideal base for Chinese automakers looking to expand their presence in Europe. Additionally, Germany's rich ecosystem of skilled labor and advanced manufacturing techniques offers Chinese companies access to decades of expertise that have set global automotive standards. China's ambitions extend beyond economics. By acquiring Volkswagen factories, China paves the way for BRICS nations to strengthen their economic influence in Europe. This move aligns with China's leadership within the BRICS bloc, showcasing its potential to compete with Western powers in high-tech industries like EV production. The acquisition of German factories by Chinese investors could serve as a gateway for other BRICS nations to invest in Europe, further enhancing their collective economic clout. However, the potential sale of Volkswagen factories presents both opportunities and risks for Germany. On the one hand, it offers a financial lifeline to struggling factories and the broader automotive sector. On the other hand, it raises concerns about the erosion of Germany's industrial sovereignty and the growing influence of China in critical sectors. Volkswagen is more than a company. It is a national treasure and a symbol of Germany's industrial strength. Selling such an iconic asset to Chinese investors is likely to spark intense scrutiny and public debate. Germany's current government has taken a cautious approach toward China, with officials describing the country as a systemic rival. This political stance adds a layer of complexity to any potential deal involving Volkswagen factories. Blocking such a sale could strain Germany's relations with China, one of its key trading partners. Conversely, allowing the acquisition could raise fears of over-reliance on China and the transfer of sensitive technology. Another concern is the potential impact on European automakers. If Chinese companies begin producing EVs in Germany, it could intensify competition, putting further pressure on established brands like BMW, Mercedes-Benz, and Audi. While consumers may benefit from lower prices, the broader European automotive ecosystem could face destabilization. The German government faces a difficult choice. Blocking Chinese investment would require significant financial intervention to keep struggling factories operational, setting a costly precedent. Over time, this approach could drain public resources and stifle innovation. Alternatively, allowing Chinese acquisitions could help struggling facilities remain viable but at the cost of ceding control over strategic assets. Ultimately, the future of Volkswagen's factories depends on various factors, including government policy, union influence, and public opinion. If Chinese investors succeed in acquiring these facilities, it could redefine the global automotive landscape, strengthening China's dominance in EV production while reshaping Europe's economic alignment. For Germany, the decision is not merely about business but about navigating the delicate balance between preserving its industrial legacy and adapting to a rapidly changing global economy.